The president has indicated that he is prepared, possibly, to withdraw from military action in the Gulf unilaterally, even if the straits are not officially open. We're going to talk with Professor Mark Guthner about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe, and welcome always to Professor Mark Guthner of Rutgers. Mark, how are you, my friend?
I'm doing very good. Nice day here. 1 month to go until school is out, and life will be good. Sometimes I'm
Nice.
as excited when the school's over as the students are.
You know, it just occurred to me because I've been having these conversations with my son Sam, who's going to be going off to college next year, and he wants to study business. That's at least one of the programs that he's gotten into. He got into an AI program at SDSU. I don't think he's going to go there, but I realized I've got to get him on the horn with you because there's only so much listening to a parent that any kid does, and I feel like sometimes you need to have a little bit of mentorship that comes from outside of one's parents because kids just get tired of listening to their parents, and I almost feel like if I say too much, it's just going to push them in the opposite direction.
Yeah.
So I just realized I don't understand why I haven't gotten him on the phone with you before now. So we'll definitely have to do
Where's
that.
he gonna go?
Well, we're going to, he has, partial scholarship offers from Oregon and Utah. He got into SDSU and USD. My wife really wants him to go to Cal Poly, but he thinks that town is too sleepy for him. San Luis Obispo. You're a California guy, so you know
Yeah,
what
that's where my
we're
brother
talking
went.
about. Oh, he went to Cal
Yeah,
Poly?
he went
Nice.
to San Luis.
Uh huh.
Yeah.
To slow, as they say. Some people call it slow. They're slow to release their admissions. That was one of the things that people joked about. SLO being the abbreviation for San Luis Obispo, which is where Cal Poly is located. For anybody who's watching who doesn't know that already.
Yeah, it's a nice town though.
Yeah, he applied to some other state schools. Indiana. He applied to Notre Dame, which is where his great grandfather went, but he did not get into Notre Dame, so that is not one of the options open to him.
Did you apply to Michigan?
And he did not apply to Michigan. I know you recommended it, and the UCs are virtually impossible to get into from California. So if you're an in-state resident getting into UCLA and Cal Berkeley, which back in our day probably would have been schools that I think you got into UCSB, right? You went to Michigan, but UCSB was where you wanted to go, right?
Yeah, that's the one that I got into. I applied in the UC system to I think it was UCLA first, Berkeley second, and Santa Barbara third. And I
Mm-hmm.
got into Santa Barbara. And my dad
Yes,
didn't let me go there. Well, for two reasons. He's telling me it's a party school, blah blah blah. But
it.
he was a Michigan alum, so I had no choice. And he tore up all my other applications, my acceptance letters in front of me on the day the Michigan letter came in. We had rock'em sock'em fights about this. Like, what kid from Los Angeles wants to go to Michigan and freeze their butt off? That's just today a lot do. It reminds me.
but you, but you went back. So you went to Michigan undergrad.
Yeah.
You came back and worked in engineering in Los Angeles, and then you went back to Michigan for graduate
Yeah,
school.
so my wife hates it when I tell this story, but I think that the game was rigged because I had my advisor at Michigan do my recommendations, and he didn't know who I was from Adam. That's the one thing about Michigan. The place is so big that it is extremely impersonal. But in any
Mm.
event, I applied to the top 10 MBA programs in the country. Um, and I decided I didn't want to go to Northwestern. So um, I said, I wonder what the guy wrote about me. So I took the app back in those days. they would send, you would give an envelope, and the envelope was sealed, and you just put that with a package of stuff and send it in. And
Mm-hmm.
I saw what he wrote about me to get into Northwestern. I'm going like, I wouldn't let me into the school either. So, but I make the application. Within 2 weeks of dropping the application into Michigan, um, I got an acceptance letter. I mean, this is old snail mail days.
So basically, it was an instant turnaround. They were like, "Oh, Mark applied. You're in."
Yeah, and then 2 weeks later, I got a scholarship to ensure that
Ah,
I would
okay.
go. And so I, some might say, well, you're not giving yourself credit or this or that, but I kind of wanted to go someplace else just to see what another college was all about. But it's the way it worked out, and it's fine. I got no
You know, my
complaints except for it's too damn
my
cold.
my mother, I wouldn't be here if she had gone to Northwestern Graduate School, because that was one of the graduate schools that she was contemplating. She applied to 4.
Mm-hmm.
Northwestern was one of them, and apparently it was one that she was seriously considering. But she decided not to do that. Ended up going to Cambridge instead, which is a good thing because my dad was doing his postdoc
Mm-hmm.
over there, and he was rooming with a student at the law school, and that roommate, that his law school roommate, my dad was not in law, but his roommate or his housemate was in the law school, and he was a part of a study group that was, and my mom was dating another law student, and my dad ended up meeting my mom when her boyfriend was studying with my dad's housemate, and he found other things for them to do while they were engaged in study. I don't think they were doing as much studying as they should have been, I guess, but apparently this involved like trips up to Vermont and stuff like that to go skiing. So anyway, I wouldn't be here if my mom had gone to Northwestern, and I don't know if we'd even, I don't know if we'd both be here together if you had gone to Northwestern, because that probably would have put your career in a slightly different direction as well.
Yeah, but I was rejected by the best: Harvard, MIT, Stanford. So it is what it is. But Michigan, I think at the time, their MBA program was rated 5 or 6 in the nation, so it's not like
No, Ross is very, very well thought of. Kellogg too, frankly.
Yeah, Kellogg's
very
great.
well thought of. Yeah. So what do we make of this? On my screen right now, I have the vessels that have crossed the Strait of Hormuz since the first of the month. I've been showing this every time that I do a live stream so people can get a sense of where the traffic was before all of this and where it is now. As a reminder, if you're looking at this and you're saying, well, hey, wait a minute, March 1st, that is the first day after the initial strikes on Iran by Israel and the United States. That's true, but it's also important to remember that ships of this size are moving at a relative snail's pace. And they don't just stop and turn around. So, and also, it's worth noting that from what I've read, the shipping lanes in the Strait of Hormuz, the entirety, shore to shore, north to south, is just 30 kilometers, basically,
right.
from shore to shore. But the shipping lanes are apparently quite narrow. 2 miles is what I heard from somebody who has transited that strait on numerous occasions. And if that's true, and you are piloting an 800 to 1,000 foot long tanker, you are not going to turn that thing around as you're entering into the shipping lanes to pass the strait. You're just going to proceed on through and hope nothing happens. So really what is representative of how the merchant marine fleet is viewing the risk is just based on the amount of traffic that we're seeing go through here. And I should blow this up a little bit so people.
So what did it look like before? Like days and days before? Is it about 30 vessels? Is that what it's saying?
Yeah, this is 29.
Is that normal traffic? 30 vessels?
So I mean, here's the thing that's kind of important, and that is that the blue, if you, this is color coded,
Mm-hmm.
and really the thing that we care most about are the gray and the blue. You will notice that the blue has been bouncing around. There were 6 ships that transited that were blue on the 1st, but there were 5 on March 21st. There were 4 on March 28th. There were 4 on March 10th. What are the blue ships? Those are what are calling sanctioned ships. And sanctioned in this case, when we hear about sanctions being imposed on another country, we're usually talking about restrictions being imposed on that country. But in this context, sanctioned actually means that these ships are sanctioned by the Iranian government,
Mm-hmm.
meaning that they actually are, of or for or an ally of the Iranian government, and therefore they are permitted to pass. The orange ones, that's sort of the shadow fleet, and as I've pointed out on a couple occasions, and we'll just blow this up a little bit, on a couple of occasions we've seen ships going towards the channel here, and suddenly they turn their AIS off,
Yeah.
and you wait a long time, and then all of a sudden it pops up on the other side. But one of the ways we can sort of see that the traffic is not normal is that under normal circumstances, the traffic would pass through the shipping lanes that go like this, the way I'm drawing this curve. Okay, so you'd have ships that would be passing through these lanes, which, as I pointed out, are about 2 miles. Okay, so they'd be going in opposite directions. You will notice that there's nothing in that region at all.
Mm-hmm.
There are ships that are hugging this shoreline, which, from the reports I've read, is what Iran has said ships that are sanctioned may do. So they're saying basically no one's allowed, if you go through here.
I was wondering why. I was looking at this map a few days ago, and I was wondering why that's the path everybody was flying on. So that's
so Iran has told these ships that they need to pass on the north side of Larak Shari.
Mm-hmm.
And the thing about this is, of course, is that essentially that gives, that sort of gives them something to shoot at.
Yeah.
In other words,
That's right.
if you're
stand over here, let me shoot you.
Yeah, our toll booth is over
Mm-hmm.
here. So if you're going to pass by and you are sanctioned, you're going to be, this is a really narrow distance.
Yeah.
I mean, this is a rifle shot in here.
Yeah.
Well, maybe not a rifle shot, but it's going to be very close to it. But basically, what that also says is that if you do not have permission to pass, to transit the strait, and you're floating around in this space, then presumably you're an open target from their perspective. Now, what is interesting is that there was a Kuwaiti tanker that was struck today. Was it today or maybe late yesterday? Let's see, is this where it is? Maybe we can get somebody to look it up. I forgot the name of it. There was some pictures of it. They punched through the hull, but I didn't see fire. But it is loaded. I mean, the tanker's low in the water. They punched a hole through the hull just after the anchor chain, but that ship was not transiting. It was not only not transiting, it was not underway at all. It was at anchor, and it was at anchor over here in this region. So it's interesting. We have conflicting. Of course, there's always going to be the fog of war, but we're getting conflicting information, and the conflicting information is that Iran is saying that ships are allowed to pass, except those that are not allowed to pass, and those that are not allowed to pass are allies of the United States and Israel, but others can. But meanwhile, they're taking shots at ships that don't belong to either and aren't even underway. So I guess my question is, we saw crude rally a couple bucks early. It fell off since.
Mm-hmm.
Last I looked, it was down a couple of bucks. Ooh, it's back to flat.
You're pretty
Pretty
close.
much down 80 cents. Pretty close to flat. The S&P rallying very sharply on this news that the president might unilaterally withdraw. What are your thoughts about this? Number one, do you think that's a possibility, which I know would be just absolute speculation? But secondly, do you think it would be a good idea from a financial markets point of view?
Well, the first thing I'd like to comment on is it seems that the markets are not consistent on what they think is happening here. The price of crude, West Texas or the New York Merc Exchange, futures is down almost a buck. I think Brent is up. Seems a little odd. Um, and so the oil market is saying no real
I
news
see.
here.
I've got Brent down about
Okay.
almost 3.
Okay. So you got that. That's the futures. I was looking at the quote over here on CNBC's website,
Mm-hmm.
on their front page. And anyways, they've got it up to 118. So I don't know. Maybe that this is spot,
Oh, that's spot Brent.
and
Yep.
you got was that six,
I'm looking at the front. I'm looking at the front month
the
most
June month?
active Brent crude future.
So
So that actually does make sense because, to your point, and an important point for viewers, the spot markets have been much more disrupted by what's going on than the futures have. Very important point, and actually, and that's not easy to correct because if there's a supply-demand imbalance in real time at any one location, um, you can't fix that straight
yeah.
away. If the oil's not there, it's not there, right? So
Right.
whoever wants it's going to have to pay more for it.
Then the second piece of that is the stocks are up big time. So the Dow is, I think, is hovering around 1,000, up 1,000 right now, with the S&P up about 2.5%. I think those have more to do with a short squeeze than anything else, because the oil markets are telling us that's not a big deal. A 2% move in oil on a significant, jawboning of the market is, to me, not a very big move. I don't think anything has really changed. The $2 change in the price of oil is I think, confirming that. But I think the stock guys, I think people were starting to really bet against stocks here, and I don't know if there's a place where we could look, but I would guess overall short ratios were probably elevated,
Mm-hmm.
and so there's a short covering because, as you know, short interest you got there, SI, right there.
Yeah, I'm gonna just take a quick peek
Um,
here. So
that
see if this is a current number.
and short sellers have an extremely short um, um, investment horizon, right? I mean, they're looking for
Mm-hmm.
something that happened fast and right away. When it doesn't happen, they typically cover pretty fast. So you see something like this. Oh, okay, the price of oil could come down 10 or 15 bucks. Oil's going to scream. Stocks are going to scream because there's two themes in the market right now. AI is going to beat the snot out of software stocks. I saw today that Oracle had a huge layoff as they're trying to resize their company. I'm sure they're getting rid of a lot of programmers so they got more money to build out their data centers. That was having to do with an article on their CDS, which is now, I don't know, I forget where it was, 280 basis points or something, 260 basis points. It's
Yeah.
trading more like a double B plus kind of stock than an investment grade. So high junk versus low investment grade.
Mm-hmm.
Um, and so they are, laying people off. And I think you're going to see lots of layoffs in the software space. On the plus side, we might see a whole bunch of new software companies get started because
This is 5-year CDS and senior for Oracle right here. You can see how
that's not
significantly
bad. I
the
don't know what everybody's getting worried about 87 basis points. Let me go see if I can find the website.
well, this is 5-year senior, right? So they've got a lot of debt, so it's probably you kind of need to look at probably various. Let's see how many. I mean, one of the issues that you have in Oracle's case, one of the reasons I haven't been as enamored of it, is that some of these companies that are building out so aggressively have easily enough free cash flow to support that,
Mm-hmm.
right? So, if you look at a company like Microsoft or Amazon or Meta, Meta a little bit less so. They've been taking on a little bit of debt to do this,
Mm-hmm.
but certainly Alphabet, these are companies that are generating massive amounts of free cash flow. In Microsoft's case, I figured that their entire capex is about 7 to 8 months of their net income. So it would obviously be a big disaster, one of the largest investment disasters in business history, if it turns out that they're making that investment for, let's just say that the real value of all of that is zero.
Yeah.
It's a complete write-off, a complete waste. They can still absorb it. It's less than 1 year's earnings. Effectively, if you think you're paying 19 times earnings for that company, maybe, and you discount everything back, you take 7 months worth of net income out of your projections.
Yeah.
That, so you're paying a mild premium, but that's something that can also be corrected, right?
Yeah. So what is your ticker here for that CDS?
So you can go down to the credit defaults, and there's like 92 of these
Okay,
things.
because the one that I
you
saw
can
over
pick.
on an article over at Zero Hedge, they show it as being 198
Oh, really?
right now. Yeah. And their ticker is
what?
ORCLCP. I think that's what they're using. CLC.
Oh, I see it here. Let's take a look. It's this one.
And maybe that's
That's 242.
242. So there's I guess a bunch of different ones given different spots in the capital structure. Maybe that
This is still senior.
is senior.
This is 9
9
year
year.
though,
Oh,
not 5.
Okay.
But this, I think, actually, I mean, a lot of times it's rates of change
Yeah.
that sort of tell the tale. And for everybody who's watching and saying, okay, well, what are they getting on about? First of all, what is a credit default swap? Why don't you tell everybody what a credit default swap
Well,
is? And I'm going to draw this and say, this is why you care.
yeah. Well, a credit default swap is a financial derivative that guarantees the return on a bond. So if I had a 5-year bond on Oracle stock and I bought a credit default swap, that in the simplest form, if Oracle filed for default, then I could sell my bond to the person I bought the credit default swap protection from for par, and I get out of this situation hold. So it's like credit insurance is an easy way to think about it. Now there's different ways for settlement. A lot of times there's just a cash settlement where they look at the difference between par and what they believe, what the ISDA believes the market price is. ISDA is the organization that regulates these things.
Yeah. So, we trade swaps. We're not trading a lot of fixed income, so we're not trading credit default swaps, but we do trade swaps. We trade a lot of total return swaps on the equity side. So when you hear a financial firm say they have an ISDA, do you have an ISDA? That means, are you basically papered up with the swaps dealers association, and then you can transact. And then a lot of times you also have to have essentially a credit understanding with the respective counterparty. And financial institutions can have a lot of different counterparties, and not every single counterparty and not every single security has the same credit rating.
Yeah.
So I can remember very distinctly during the beginning of the GFC, so this is in the early stages of it, but we knew things were getting pretty rocky, and I had a trade that we were doing with Bear Stearns. And I remember exactly what the trade was. It was a trade of 25,000 Vega. It was a variant swap in Walmart. So single stock variants. It's not a trade that people do a whole lot of anymore. I don't think even banks trade single stock variants anymore. Maybe they do. If somebody knows, you can correct me on that. But that business pretty much evaporated after the GFC. But I remember quite distinctly that when we were consummating the trade, that the person on the other end of the phone with me gave me their Bear Stearns counterparty, and it was like Bear Stearns London Partners 3 or something like this. So, when the banks are transacting, they had all of these various counterparty entities, and they would tell you which one it was, and then our credit department would essentially, like a credit card, run their credit, and then they would come back to me and say, yeah, that's good. You can print it. And I remember quite distinctly that the trader on the other end gave me a give up at Bear, and I ran it through our credit department. They're like, yeah, that's no good.
Mm.
And I was like, so I went back to the guy at Bear and I said, I can't trade with that counterparty. You got another one? And he gave me another one, just like Bear Stearns whatever London 4. So I ran that to the credit department. And the credit department said, yeah, no, we won't do a trade with them either. So I told the guy, you have any other? I mean, literally, he's going through his really is going through his wallet. Like, how about a different credit card? He's just giving me one after the other. He gives me another one, and I get that one, and they put it through. And I remember going back to the trader, whose name was Aaron. I said, hey, Aaron, everything all right with you guys over there? He's like, oh yeah. And of course, Bear Stearns, as you know, and as probably a lot of people watching will know, was one of the first notable firms to find itself in real trouble. Basically, he was not part of the Chiaffi hedge fund. There was a fixed income hedge fund at Bear Stearns. It was run by a guy named, I think, Ralph Chiaffi, if my memory serves me correctly. And they got into trouble. Bear Stearns bailed them out. I was actually dealing with the traders at the investment bank proper. But it was right before all of that. And, those are the types of things, just for anybody watching, especially anybody who's younger, who might find themselves on a desk one day. And, when you start to see smoke, don't wave it away, is the only thing I can say. Is that on a couple occasions in my professional life, there were some warning signs, and on at least one or two of those occasions, I thought, it's probably nothing. And it later turned out to be a whole lot more than nothing. So it was Ralph Chiaffi, that's right. So
I know Ralph. I almost went to work there.
Oh, you almost worked for that fund there?
Yeah, so I knew Ralph. He was a salesman, and then became
That's
sales
right.
manager in fixed income there. And I did business with him for, I don't know, 5-6 years. And I ran into him.
Is this from your Pru days or your Bank of America days?
No, that was my Pru days. And I always thought he was a very smart and honest guy. He was a good guy to do business with, and a guy that I certainly trusted. I knew him for years, and then I was sad to see that. Well, first of all, I was happy to see I didn't go to work there, and then I was sad to see that he blew up. And to my mind, their problems were more like long-term capital management, where they just use too much leverage, where the margin of error is just too small. You go think about long-term capital management. What are they levered, 40-1 or something?
It was a lot of leverage. Yeah.
And it's like, okay, so your book slips by 2%, and now you're insolvent, whatever. That was his biggest thing. I went, in fact, the SEC sued him, tried to throw him in the big house, and I went down to the Brooklyn courthouse and sat in and watched a fair number of days of the court case, because I was very interested to see what actually happened. And it was quite a thing, because the part of the courtroom I was sitting in, I was surrounded by a bunch of lawyers, both wanting to know how to defend about these kind of things, and the others on how to prosecute. Because, as you know, there was a ton of banks that went under. There were a ton of different funds that went under. There were banks that went under. There were a lot of illegal activity going on, especially with the origination side of this. But I think they wanted to figure out if there was a way to defend and or convict. And I I sat there long enough to realize that the government had no case at all. So, but they figure, well, here's just some guy who's now you know, a below C-suite but executive kind of guy. Maybe we can go rough him up. And he used the same lawyer that Bill Clinton used back when Bill had his troubles.
Oh,
It was a DC.
was this? I'm trying to remember.
Anyway, we're getting.
I mean, there is one. Yeah, we're getting a
it-
little far afield of the
yeah.
conversation, but it is very interesting. I think people are probably interested in this kind of thing. I didn't realize. I mean, it doesn't surprise me that you knew him. I didn't realize that you knew him as well as you did, and certainly I didn't realize that you were down in at the Brooklyn courthouse listening to them attempt to prosecute him. I agree with you on the origination side. I think it's an important thing for folks to remember how this business, in the mortgage business and the mortgage bond business, kind of worked, and that was that, at the core of all of this was that there was a significant decline in underwriting standards for mortgages. Some of that was precipitated by legal changes that took place in the late 1990s. There were some folks in Congress who had helped try to promote. The logic in some of the things that were put forth was that it was going to be more of a democratization of sorts of access to mortgage lending. Because conventionally, the way people would borrow money before you had mega banks and you had these mortgage brokers and everything else, is that when my parents got their first mortgage, they went to the local savings bank. And they went to the local bank in the town where they lived, and they took out a mortgage. And you had a local bank, often a mutually owned bank. So it wasn't even a for-profit institution. Mutually owned banks were owned by their depositors. And so you had a mutually owned nonprofit savings and loan effectively, and they would take out a mortgage. And of course, the people who are underwriting that, they are the friends and neighbors of the people whose money it is that they're loaning it out, and they are loaning it out to their friends and neighbors. They know who they're loaning it to, they know what they're loaning it on, and they know whose money they're loaning. And consequently, that would create a certain amount of risk aversion. Now, that's not necessarily the best way to do things because that creates a lot of regional problems. You have a lot of concentration risk in that sense. It can make sense to spread the risk around, and there were a lot of deregulatory things that took place in banking, and banks merged and a lot of stuff like that. But of course, what happened in the GFC was that you had mortgage firms like Countrywide, and they made their money by writing loans, not by wearing them, not by putting them on their balance sheet. And so the more loans you wrote, the more money you made. And then that all got shipped off to banks, and the banks stripped these things apart and then packaged them back together and created mortgage-backed bonds. And sometimes they would package just the interest and sometimes just the principal, and they would group the bonds by all kinds of categories. And funds like Ralph Cioffi's, effectively what they would do is they would take some measure of leverage and essentially get into basically a positive carry. You use that money that you borrow relatively cheaply to invest in fixed income assets that earn a little bit more, and you make the difference. And mortgages have traditionally been thought of as one of the safest things to invest in because people tend not to default on their mortgages and because the collateral is usually good and the value of that collateral generally rises. And you put all of those things together, so it has long been viewed as a very safe place to invest. And what we had in the GFC was a decline in lending standards, a complete disconnect between the risk of wearing the risk and originating the risk, and that was certainly problematic.
That's right.
And then of course we had a big liquidity problem. So long-term capital markets, when they failed, they also were in one of these trades where they took on leverage. What's amazing is that they actually had more capital before things went awry for them in, I think, 98, I believe is when it was. But they returned investor capital because the principals, they figured we, the principals, have enough of our own money invested in the funds that we don't need to share the profits that we're making with outside investors. So they had actually just recently returned a lot of the excess capital that they had as a hedge fund back to their investors, so that the internal participants could take a bigger share of the P&L. That obviously turned south when the market got dislocated, and the same thing happened in the GFC. You had a lot of stuff that was bad paper.
Well, I'm happy to see that unbridled greed was well compensated.
Yeah, I mean, and then of course you had situations. Yeah, so, all right. Well, we also have some questions here. Maybe we'll take some of these. Youth is wasted on the young. Indiana is in a great college town. I graduated from IU, left Bloomington for 22 years, and then moved back. So two of us who are involved with the making of this video have spent a little bit of time there. My brother and I actually, while I was doing a cross-country motorcycle trip, stopped in Indiana as a part of that trip because one of my best friends and college roommate, he went to law school at IU, and his sister went to law school at IU, and we stayed with her many, many years ago. So yeah, I agree. Great school, great town. I don't think my son is going to end up going to Indiana, though, although I would have been very happy if he did. Great place. So Mike asks us, what's your opinion of Stephen Perneau and using STRC for cash management in combination with portfolio monthly rebalance to generate a Kelly criterion score greater than 90%, given STRC yield is 11.5% paid monthly? So I guess, Mark, what are your thoughts about instruments like STRC, the strategy preferreds?
I think it's a very interesting security. I own a little bit of it myself.
Mm-hmm.
And it's one of these, it's a different kind of floating rate security. Most floating rate securities trade at a spread over some benchmark. So you get 1% over 1-year treasury bill rates, or in the old days it was over LIBOR. Now it's some spread over so for the secured overnight funding rate. It's a rate that banks charge each other for secured lending. So if rates go up, you get a bigger coupon. If risk-free rates go down, you get a smaller coupon. What this one does is that if the security is trading at 99 or less, well, it's trading around 99, doesn't have to be. They'll increase the coupon by 25 basis points. And if it's trading around 98, they'll increase the coupon by about 50 basis points. They'll make that adjustment every month. And so if it gets to a premium, so let's say it goes to 101, they might cut the coupon by 25 basis points. So at 102, they'll cut it 50 basis points. So what they're trying to do is they're trying to keep the security trading at a price between essentially 99 and 101. So it becomes like not a money market fund, but let's call it like a 2-year note fund. Something that have a very low level of interest rate risk in it. Doesn't quite trade at par all the time, but will wiggle around it. And so I think it's an extremely interesting vehicle that no other company that I know of has issued a security like that. This is sort of like how credit cards work. So if you get a credit card from XYZ Bank and your FICO score goes in the tank, they're going to raise your rate.
Rate goes up.
Or if it gets a lot better, they lower the rate, or they'll just let you go someplace else and you get a better deal elsewhere. And the other thing that's kind of interesting about it is right now the dividends are returns of capital, so they're tax deferred. So that's an interesting kind of thing. What MicroStrategy is doing is basically they're making the following proposition. We think for the next couple of decades that Bitcoin goes up by 30% per year compounded. And they want to go borrow money at something less than that. And it seems that right now the market clearing rate's about 11.5%. Says, okay, we'll pay you 11.5%. We'll take the volatility, and we'll earn 20% for taking that volatility. You, the
The
STRC
lender.
owner.
Yeah, I mean the buyer is a lender
Yeah,
essentially in this
yeah.
proposition.
So he's the buyer of that security. Lends. They're essentially lending to MicroStrategy. They're using it to buy securities, and so what they're doing right now is they just want to buy Bitcoin as fast as they can. So they will sell. They got a huge shelf offering of this. I think it's something like $21 billion shelf
Mm-hmm.
offering. There's a really interesting website if you want to call it up. It's strc.live,
Mm-hmm. I'll
and
pull that up.
it shows what they're kind of doing in real time.
Mm-hmm.
So there you go. Click on that. So if they can sell these things at par, they will, and then they immediately turn around, use the cash to go buy Bitcoin. So this little website shows you what they're doing in real time. They've got like 19 different brokers that will originate these securities for them now. So they got a lot of them.
Mm-hmm.
So any institutional guy comes in and says we're willing to buy these things at par, they'll say fine, we'll take them from you at par, and then you can see how many Bitcoin they're buying today. You're oh, see, I just refreshed, and so I'm on here. So you can see today they've bought about 1,517 Bitcoin so far, and as long as the price is here at 100, they're going to keep going. I guess they've sold 2.47 million shares of this STRC, and that's
Mm-hmm.
the game they're playing. A game that we think that the Bitcoin will deliver 30%. We're willing to pay 11%, and we'll take 19% to absorb the volatility, your volatility. And interesting strategy. Nobody's ever done that before that I'm aware of. And it'll be very interesting to see how it works out in the long run.
Yeah, I mean it's interesting. One thing that's interesting to me here, it does seem to have done a pretty good job of stabilizing the price. This dividend
Yep.
scheme that you've
Yep.
outlined. The important consideration for investors is that, of course, preferred dividends. You know, it's kind of that hybrid lives between equity and fixed income, but it's really a fixed income instrument. It's going to be a little bit junior in the cap structure, probably, to some of the bonds that they've already issued. From an operating flexibility standpoint, management would tend to prefer this because if you find yourself in a situation where you do not want to or cannot pay the dividend, that doesn't necessarily have the same implications for the business that failing to meet a bond coupon would. Now, in their case, some of the bonds they have are, I believe, zero coupon converts. So that doesn't mean that they have any cash flow implications in the short term. I think if I was looking at the business, that's an important consideration because one thing to think about is that, as you pointed out, they're forecasting that Bitcoin's going to appreciate at a certain pace, and they are willing to pay some amount of interest that is considerably less than their anticipated rate of growth. In the examples that we were just providing, whether it was Ralph Ciaffi at Bear or whether it was the long-term capital guys, where they found themselves in trouble was when they got upside down, basically, meaning that the value, the mark-to-market value of the assets that they held, was going down much faster than the value of their liabilities, and they actually got upside down in the case of long-term capital management, at least on a mark-to-market basis, to demonstrate that the assets probably were underpriced at the time. They reached out to Warren Buffett in those days and asked for a bailout. Basically, they went to Goldman Sachs also. Both of them kind of turned him down, and then quietly went behind the scenes. And Goldman Sachs and Warren Buffett were quickly working out what they thought they would happily pay to take those assets off their hands. I think Warren had told John Merriweather, who was the head of LTCM, that this was a little too complicated for him. And old Warren, cagey fox that he was he recognized that he was likely going to be able to get a good deal if he waited, and so he actually started taking a look at it behind the scenes. But in this particular instance, what can happen? Very interesting, Finwest, that you're talking about Restoration Hardware. We have a position in the name, and yes, it's not a local. The local Restoration Hardware here, I'm going to get to that in just a second. But the interesting thing about this is that if you're in this arrangement where you are purchasing an asset that's highly volatile, Bitcoin is clearly highly volatile, and you end up borrowing money at 11.5% to pay 80 for it, and then it drops down to 65, that's kind of an unhappy circumstance. If you are issuing a security where you're promising to increase the dividend that you pay whenever the price goes down, well, what's going to cause the price to go down? The price is going to go down when the value of your assets, so that's the book value of Bitcoin, declines. People would be likely to pressure the preferreds, because ultimately at the bottom of the cap structure, that's all they have. They don't really have an operating business beyond their not meaningfully anyway, outside of their book of Bitcoin. And so they end up in a short convexity situation. That is to say that at immediately the moment that the value of the assets that they hold starts to decline, the terms of their preferreds are that they're going to pay more, the way you just described it. Is that right?
Yeah. So it's a weird kind of payoff pattern when you think about it, because as things get worse, the coupon will keep going up and up, and the price of your security is going to remain more, close to par. But then there's some sort of shattering breakpoint. Where is that? When Bitcoin's at 10 grand or something, or 5 grand? I don't know what it is. But there's some price in which, okay, they've got to suspend the dividend, and then the thing would collapse in price. It is a cumulative preferred, so if they got back on their feet, they would make up the security that
the missed payments, the missed dividends.
Yeah. Now, if you go to strategy.com, this kind of shows their different preferred stocks. So that first one where you're there, that's the common stock. STRC was just what we were talking about. And then STRK, I think, is the that might be the convertible. Net 71. That's the convertible. So that's convertible into 0.1 shares of MicroStrategy. So essentially, the strike price is like 1,000. So that's like a busted convert. It's way out of the money. STRD is like a long duration fixed coupon kind of security. And then there's STRF, and I think that one's the same over one more.
Oh, oops.
STRF. I think that one. Oh no, that one is that's the long duration one. The other one, STRD, I think that one is non-cumulative, and STRF is a long duration, is like a long duration security that is cumulative. So you can see what he was doing. He was kind of testing the market to see what kind of price people would want to pay and what kind of security people would like to have. And they prefer to do this, I think, as preferred stockholders, because issuers, because for two things: they don't really have accounting earnings, so they can't take advantage of the interest deduction. And two, it's nice to have the flexibility if you're going to make a big bet. to suspend your
Is that
dividend without terrible recourse, without being put into
the
bankruptcy.
the favorable tax treatment, return of capital, and the nature of these dividends? Is that because of the company's also because of the company's operating income?
Yeah,
Is that the reason they're
the
able to
way
do that?
I thought it was because they didn't make profits. And then I've read
Hmm.
elsewhere from other people that it's because they're raising money with stocks and preferreds and then paying out their interest from the money they raise from the stocks and the preferreds. I don't know. I don't.
Rather than from any realized
Yeah,
profits from the
right.
underpinning, because in the fund context, so where we can pay a distribution, and we can pay a distribution even though the net asset value of the funds may have declined, if we have realized gains.
Hmm.
And if we don't have realized gains, even if there are unrealized gains, and we pay out a distribution, then that's characterized, as far as the IRS is concerned, as a return of capital.
Yeah.
So I'm wondering whether, in this context, it works much the same way. I'm assuming it does. For those who don't know, this is a really important thing. So if you are in a taxable account, so if you are a taxable investor, probably most of you are in at least some of your investments. If you invest in something that pays out distributions of one kind or another, and those distributions are paid to you as return of capital, from a tax treatment perspective, what that means is that event, that distribution, is not itself taxable. What it does is it reduces your basis in the investment. So if you invest $100 and you take $10 out in distributions, your basis is now $90. So if the value of the fund assets or whatever it is has remained at 100, then when you go to sell it, you are going to then realize a $10 capital gain. And depending on how long you hold that asset, that could be a short-term gain or a long-term
Yeah.
gain. But the short version is that for most investors, return of capital as a characterization of the distribution from tax perspective is generally preferable because it doesn't create an immediately taxable event. Whereas if you get an ordinary dividend or ordinary income, then that is a taxable event. Now, individual taxpayers, your circumstances are going to vary because maybe you're in a tax period and you have losses and you wouldn't mind if it came to you as income because now's a convenient time for you. So, obviously this isn't intended to be tax advice. Everybody has to investigate their own situation individually with their own experts. But the fact that these distributions from these preferreds are coming as return of capital is, for most investors, that's probably going to end up being a good thing, because essentially what you're doing is you're deferring the taxes until ultimately, if ever, it becomes a long-term capital gain.
Yeah.
So that is an important consideration. Let's see here. And on the Kelly criterion, what do you think about that? So people who don't know, do you want to explain what the Kelly
I
criterion
am not
is?
an expert in the Kelly criterion, so
I,
I'm uncomfortable.
yeah. So the Kelly criterion was named after a guy who worked at Bell Labs, and what he was trying the problem he was trying to solve is how much am I supposed to wager on a bet of any kind? Could be a game, it could be a stock, it could be just if you have a certain amount of capital and there are certain things about a bet that you could potentially make, what the odds are of winning and how much you expect to win or lose. So those are really the critical inputs, right? How much capital do you have? What are the odds of winning or losing? And how much do you make if you win or lose on a bet? What is the optimal amount to wager every single time you're presented with that conundrum and you know those factors? So that's basically the whole concept of Kelly criterion. It was really meant for betting games, but it can be deployed in other contexts, such as investing and trading. And I'd actually have to give this one a little bit more thought because you, with a portfolio monthly, to generate a Kelly criterion score of greater than 90%, one of the issues that I have is that I have to model out, actually, and I'm sure Mark would do this too, is that STRC has this kind of knockout feature, as you were pointing out. Basically, for as long as they can, they will basically keep the price around 100 until they can't, at which point it's going to go to instantly to some other number.
Yeah.
And I don't actually know what that probability is. I'm not even sure I could know if I worked on it, but that would be something I would need to know before I could start really figuring out what the appropriate way to think about it from a Kelly perspective might be.
Yeah.
Jen is saying, and I'm sure that Jen is referring to the traffic in the strait, that the 80 to 100 ships per day is normal according to Google.
Okay.
Mike Anthony is saying, what do you like in small caps? Anything in small caps that you like? I'll see if I can find. I don't usually look too much in small caps by virtue of what we look at, but I'm going to take a peek right now.
Well, one of the things I do like there, the guys over on Fast Money were talking about yesterday was Novo Nordisk, NVO. They were one of the first companies up with GLP.
Yeah, it got pretty hard hit.
Yeah, so they originally made that drug for diabetes, and they found that, and it did a good job of treating diabetes, but they also found that it helped people lose weight, and that's where that whole thing kind of caught its whole thing. Now, what I think is interesting is the stock is now trading at a price. I think it's now trading below where it was when they first started selling Wegovy as a weight loss drug.
It is at the moment trading. So it was 27, 36 now. It's trading about 40% above where it was 10 years ago.
And bear in mind, and full disclosure, I own a little bit of this too. So they're making good money now. They got beat up because Eli Lilly's drug head to head is a little bit better, or it causes a little bit more weight loss. The numbers are, I don't know what the numbers are, but they were something like 24% weight loss versus 20% weight loss. So the street acted as if Lilly's going to get all the business, and Novo is going to get left in the cold. I don't think that's going to be the case. I'm sure there's going to be differences for how much people tolerate these drugs, but also you got to ask yourself, do you actually want the most effective drug? Because look at a lot of these people from Hollywood that have taken it. They now look like they belong in a movie on the zombie apocalypse. I mean, they do not look healthy at all.
You know, it's interesting you mentioned this because I read that there are some firms, some trading firms, that are prohibiting people from taking some of these things. And the reason they're prohibiting them from taking them is they said it reduces people's interest in alcohol, it reduces their interest in certain foods they shouldn't be eating, and it reduces their interest in damn near everything. Apparently, and I don't take these drugs, so I don't know. Some would argue I probably should. But I have heard that when people, if you take a shot a week or however often you do it, but for the first couple of days, that people's general level of interest in almost everything drops. I don't know if that's true. What I do suspect, though, is that it's hard to imagine that drugs that have such a profound effect do so without cost.
Yeah.
I don't know what the cost is, but in my experience, there are trade-offs for almost everything. And it seems highly unlikely that these drugs don't have one.
Yeah.
And so to your point, if there is one that is a more modest variant, then presumably it might have maybe it has a more modest trade-off. But another way to look at it is right now it has an enterprise value of 176 billion US.
By the way,
probably
Novo has also come out and got approval to sell their product in a pill form. Now, up until till then, I guess it was about a month ago, you had to take an injection.
All shots. Mm-hmm.
And who likes taking an injection? And I understand everything I read is the pill form of this is doing quite well. Everybody's afraid that Lilly and others will come out with some pill that will compete, and so it just seems like people will, I don't know, think that NVOs just can't compete. It, I don't listen. I'm not an expert in this space, but it seems like people are
Well,
maybe a little overdone.
it's trading at 11 times next year's earnings estimates at the moment. That's reasonable. It's trading at a better than 5% free cash flow for next year. That also seems reasonable, especially given the anticipated growth that they're talking about,
Hmm.
assuming that this stabilizes. I will make one quick comment, which is that I think Michael was asking us for a small cap, and I don't know that
Yeah, this is
Novo
more like a
has
medium cap, I
170,
guess.
170. I mean, this would have been a mega cap company not that long ago.
Hmm.
We used to think of small cap as $1 billion, and then mid cap was going to be over 10. I think the average size in the mid cap Russell right now is probably in the 30-40 billion-dollar range or
Hmm.
something like that. Maybe that's even small caps. I should probably check and see.
Yeah, what's the average
But
size of a stock on RTY?
yeah, RTY that's going to be the universe that we're really looking at if we're looking for small caps. And so, the same thing that typically applies. Uh, I, I got off of an investment committee meeting right before I joined this call. In fact, I think you might have overheard some of it, maybe because I was on that call and I was just booting up the camera and stuff. Um, People who watch me, I have my own take on. Oops, this is not the RTY index, by the way. I'm gonna put this in here. My take is that I have said many times that the S&P 500 is a very nice thing to invest in, full stop. So if you're going to start looking for stocks, you're looking for things that are compelling on a relative basis. And that means that either they're trading very, very cheap or they're growing faster or maybe both, right?
Hmm.
But if you can't find something that is obviously interesting relative to the market, then it's maybe an exercise that's, you might be putting in more work than you're going to get a good return on. And so for me, I'm looking for companies that are going to be growing over time. So I'm going to just start right now by saying, okay, let's just say that I'm going to look for companies that have a top line sales growth that is north of 5% on average over the course of the last 5 years. Right? That would be considered a growing business. Let's just add to that I'm going to say that I'm hoping that EPS growth is going to be better than what the S&P has enjoyed. Or maybe even I'll say that I'm hoping that revenues are growing at least as fast or faster than they have over the last 12 months than they did over the prior 60. And when you start to do these types of things, one of the things you will find is that you can take a big list of stocks like the Russell 2000 and you cull that list pretty notably. It's very difficult. It's a long list to go through. And here's something else, right? One of the reasons you need to kind of cull the list in this way is that think of a company like Supermicro, which recently got itself into real trouble. The stock's down I think 30%
Hmm.
over the course of the last 45 days or so. Is a company that we held in a couple of funds. It's not a company I was totally enamored of. And the reason I didn't like Supermicro was because Supermicro had some accounting issues several years ago. You may remember that. I think they had an auditor who even quit. And so I just didn't like that. They had some transactions going on that were not completely arm's length. That was just, remember what I was talking about earlier. When there's smoke. One of the things you learn in this business is when there's smoke, pay attention.
Well,
So you had an auditor that wasn't that happy about it. You had these transactions that just looked a little bit fishy, and lo and behold, one of the founders of the company was just arrested by the feds, and it was because they were violating export rules on some proprietary technology, and it just goes to some of the things that were worrisome then. These were the same people doing it, right?
yeah.
So, what's my point in all this? The reason that I like to filter down this way first is because I want to find companies that, number one, have a reason to invest, and number two, I have to have a narrow enough list that I can actually do the work. Because right now I'm down to 200 stocks. 200 is already too many. I can't become really intimately familiar with 200 small cap stocks really quickly. So I need to say, okay, you know what? There's some of these things that I'm going to say, okay, I don't want to have anything here. So I'm going to just take a look and say, okay, I don't want anything that I want positive revenue shifts, perhaps in estimates over the course of the last month. Now we're down to 95 stocks, and maybe I want the same thing on the earnings side. And now I'm down to a list of just 54 companies, right? And now you can see what some of these are. So, and now let's just take one further step and just say I'm gonna come up with some arbitrary valuation threshold, but let's just say that I want companies that are trading at less than a market multiple. So we'll just say it's less than 22. Now we're down to 37 stocks, and we're gonna wrap this thing up, but I'm just gonna scroll through here, and I don't know if can you see this list, Mark? Anything on this list you think that's worth taking a deeper dive into? We got a number of regional banks.
Yeah, none of these are companies that I know very well. Regal Pharmacy, I don't know that one very well.
BGC, I obviously know that one a little bit. BGC is largely owned by the Cantor Fitzgerald Partnership.
Yeah.
I'm a former Cantor partner. That's basically the interdealer business for Cantor Fitzgerald. It's basically the investment bank and institutional sales and trading is Cantor. And the interdealer business, as far as I understood it, because I didn't work on that side, on the BGC side, was BGC. And also that was the part that bought the electronic, and it bought and then sold they had that electronic bond trading business, which they sold to NASDAQ a number of years ago. Mm-hmm. Really interesting deal because BGC was valued at about $650 million before Howard sold that business to NASDAQ, and he sold it to NASDAQ, I think, for like 1 to 1.2. There was a floating payment schedule that depended on the company's operating performance over some measurable period of time. But he made a sale of one of BGC's assets for more than the entirety of BGC was apparently worth on the day prior.
Wow.
So I think that's... can Mike send us his filter on things he looks at to narrow down to good stocks? Well, I can tell you what those are. And I will tell you again tomorrow when I do open mic. But here's, in a nutshell, and Mark, I'd love for you to contribute your thoughts. But here are the things that I look for, as I previously said. When I start my screening process, I'm looking for companies that are growing. And that is because companies that are growing, I can make a lot of mistakes, but time may fix it.
Mm-hmm.
If it's a good business and it's growing faster than the economy, and that's one of my measures, right? If the economy is growing at 3-4%, I want a company that's growing at 5% at least. I like to see earnings growing at a similar pace. I have a very simple logic to this. If a company is in a good business, their margins aren't going to continue to get compressed. And that means that if their top line's growing at 4 or 5%, their bottom line's probably going that fast or faster. So that's another simple screening criteria that I use. I do look at, I don't eliminate, but I do care about the rate of growth. But that can be a little bit problematic because you can have companies that they've developed a new product and they're on a total hockey stick, right? Mm-hmm. So we were just talking about a company like this, Novo, come up with a GLP-1 and they have 50% top line growth and then it slows to 7%. Does that mean it's a bad business? No, you can have that kind of a roller coaster. So I'm willing to look past a slowing growth rate if I can understand why. If it was a result of a hockey stick like this, like NVIDIA's GPUs catching fire because of data centers or whatever, I can look past those things. But I'm still looking for that top-line growth. And I'm looking for, a quick thing that I look for is estimate revisions. If analysts start revising revenues or earnings lower, that to me is a red flag. And the reason it's a red flag, if it's immediate, if it just happened, is because I have seen that on the sell side, it's very common for there to be a lag. Even if they're doing work, they know something's starting to degrade. They may not get it out in time, so there's always this lag. So, generally speaking, if I'm seeing those estimate revisions come down, that's usually a sign that there's actually real evidence. This is that smoke thing I was talking about before. You know, you see smoke. That doesn't mean you can't look at it, but it does mean don't make it an easy buy. So. That's certainly one of the things that I would take a look at. Our production staff is now saying that we have run over our designated hours, so I'm going to have to cut this one short here. But I hope you guys tune in next week. Mark, if you're around next week, you're still
I am here.
not going to be totally sideways grading exams or doing something.
I'm
So
giving exams
we will have
next
office hours next week on Tuesday at 2 Eastern time. I hope you come back for that. And of course, you can always tune in tomorrow at 4:15 Eastern for another open mic. Like, subscribe, notification bell, send us your questions. And as always, Mark, thank you for joining me. And as always, for all of you watching,
Pleasure.
thanks for watching.
great one.
We'll see you soon.